I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-aligned test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, welcome to Financially Speaking with Jeff Bush. My name is Steve Jablonski and I host the show. And today we have a very exciting topic, and it's retirement income and the sources of that. And before we get into that, hello, Jeff.
Hi, Steve. Welcome to the show. Good to be here. This is, once again, we're here at our offices here in Pottstown on 152 East High Street, the corner of High and Hanover. And we've done the last few shows here, and it's worked out pretty well. We've gotten good feedback from our viewers, and of course it's nice. It's in, we're right here in our comfort zone, right here in beautiful downtown Pottstown. So this is where all the action is. So today we're going to talk about income and retirement, right?
Yep.
Okay.
Yep. And before we get into that, as our name says, informed family, and we like to educate people. We've been in the news recently, so maybe tell us a little bit about some of the things that are going on there.
Yeah, so I was featured in the Reading Eagle a few months back, and I was also interviewed for the Kiplinger newsletter. So I did a couple of articles there, and of course you were featured in the Norristown Patch. Our former colleague Barry was in Investopedia, and we were in Yahoo News and U.S. News and World Report. So we really had quite a busy few months there, being in the news. It's surprising we got any other work done, but it's always good to get the word out. We love doing that stuff, Steve, and it's good for really like you said, informing the public. And we do live seminars. We do the TV show, so it's really a good method of outreach, if you will.
Good. So back to the topic, and when we look at people in retirement, and we get a question frequently of how much is safe to be taking distributions, what percentage, and that environment's changed a great deal from 20 years ago to today. So maybe you can talk about the market and what's that look like?
Well, the market's different than it was 20 years ago, I guess is the easiest way to say that. But back in the good old days, they used to use a safe withdrawal rate of 4%. And now when they run these models, 4% isn't so safe anymore. And the reason for that, quite simply, is that interest rates are dramatically lower today than they were 20 years ago. The yield on the 10-year Treasury rate, as we're taping this today, is hovering right around what is it, Steve?
I
the
just heard
last
this
time
morning
looked?
it's 1.7.
1.7.
Yep.
Yeah. So it's been below. It's been below 2 for a while. I know when we did our the last workshop a couple weeks ago, it was at, I think it was at 1.6. So it's creeped up a little bit, but not much. Anyway, the point is that you can't get much yield from
Yep.
interest-bearing notes, whether that's you're holding a bond, whether you've got money in a CD, a bank note, whatever that is. So to get any kind of withdrawal better than that 2.6 safe rate. And by the way, that comes from I believe a white paper.
Yep.
That's been floating around from the American College.
Yes.
Where there's a 2.6%, and that's, I mean, even that, and that's not even guaranteed. That's just a kind of a benchmark that they're using for withdrawals. But quite simply, it's just because interest rates are so much lower than 20 years ago. Interest rates were higher, the stock market was booming, and these are very different times.
Yeah, because the stock market, when you look at 1980 to 2000 versus the last 20 years. It's been a huge difference.
Yeah, it has been. I mean, when you look at equity markets, we like to say this is not your father's stock market. Well, your father's stock market, defined by the 80s and the 90s, was a pretty steady upward climb. The average return over that 20-year period of time was probably upwards around 17%, and now we're in a very volatile period of time in the market. So what that means is we really just have to go towards safer products.
And not only has the stock market changed and the interest rate environment changed, but there's a basic in retirement planning called the three-legged stool. And tell us a little bit about that. How's that changed?
Yeah, well, the three-legged stool is, we used to say, well, when you retire, you're going to get your income from Social Security. You're going to get it from a pension, and then the rest of it's going to come from retirement savings, whether it's an IRA or a 401k or maybe investments that you've saved up over the years. Could be an annuity. But what we're finding today is this is not your father's stock market, but it's also not your father's retirement. The pensions have gone away, not gone away, but they're much less prevalent today as we do our planning than they were a generation ago. People just don't have pensions. So what that means is they're relying more on personal savings, which gets back to the safe withdrawal rate. So it's quite a quandary. Retirement today is very tricky.
And if pensions are going down and there's a lot lower percentage of people that have them, what are some of the things that people could do? And instead of maybe return, it's more about the reliability of income.
Well, a lot of it, goes back to the guarantees, and in our practice, we build a lot of what we do, at least the base part of what we do for income, with annuities. Okay, and a lot of these annuity products have guarantees built into them. So it could be a rider, which guarantees the income over the course of your life, or you and your spouse's life, or it could be an immediate income, which is paying you out over your life. Well, when you do something like that, Steve, what you're really doing is you're shifting the risk to the insurance company, and because of that, and them assuming the mortality with that. So you're now in with a pool of other people with similar in similar annuity products or similar riders, and now it becomes a question of mortality. So they can guarantee you a rate and maybe offer you a higher payout. So that's why, you see, maybe, a 65-year-old, we can see maybe getting a payout of 5%, depending on the company and the rider you choose and that kind of thing. So that's why we see a lot of people migrating to these products, because if you just have a portfolio of investments where there's not a guarantee, well, then you got to go down to that, closer to that 2.6%. I mean, that's half the rate of return.
Yep.
So it makes a big difference. And of course, I said we're a big proponent of annuities. It's not, we're not a proponent of putting all of your money into annuity contracts. We believe that you should have diversification in your portfolio, and you should be able to have proper liquidity and all the other measurements of a good financial plan, risk tolerance, and all that. But when you're building a portfolio for income, having an annuity in there that has some sort of a guarantee built into it, I think goes a long way to generating good income, because you're shifting that risk to the insurance company.
And if we think about it, the few people that do have pensions now, aren't the pensions, the companies are doing the same thing?
Yeah, I mean, that's essentially what a pension is. I mean, really, when you think about it, that's what Social Security is too. It's an annuity. But you're right. A pension is an annuity contract. So there's the big pension company goes out and buys annuity contracts to match the obligation that they have to the people that are receiving these pensions, and that's how they can receive these guaranteed checks for the rest of their life, is because it's backed up with an annuity contract. So, in fact, that's one of the ways that I present that is I'll say, when you buy these annuities with these income benefits, whether it's an immediate annuity or an annuity with an income rider, you're simulating a pension.
Yep.
You're buying a pension. So what you're doing is you're carving out a piece of what your retirement assets are, and you're saying, okay, well, with that portion of my retirement assets, I'm going to put into an annuity that's going to generate guaranteed income.
And to not get too deep into the types of annuities, but if we could talk about 3 different types of annuities today, and maybe a couple of the features for people.
Yeah, so you could go into a fixed rate annuity, so they're going to pay you whatever interest rate is prevailing. And of course, they're not very popular right now because interest rates are so low, like we talked about earlier. But you can get a multi-year guarantee, so you can go out and buy a 5-year guarantee. So you're getting the interest, whatever interest rate is prevailing for 5 years. You can also, under that category of fixed, is the the immediate income, where you're giving the insurance company a certain amount of money, and then in turn for that, they're giving you an immediate payout, which could come in a couple different forms. It could come in a lifetime payout for the person who's buying it, or it could be joint. Could include the spouse. We could put some guaranteed terms in there, like what they call period certain, so we can guarantee it for 5 years or 10 years. So that's the fixed.
Yep.
What's really become popular in the last 20 years are index annuities, where the performance of the annuity contract is tied to an underlying index. Most popular being the S&P 500. Yep. So based on the performance of the index, you're going to get a portion of what the index does. And the reason why these contracts are so popular is because there's no downside to principal. Okay, so if we have a bad year in the stock market, then you don't absorb that loss. You simply just stay where you are. You get zero. So in a very, very bad year in the stock market, so let's say you owned one of these index annuities in 2008. Well, you wouldn't have lost the 38% that the market went down. You would have just stayed even. So that's a very popular product as well. Now we got to talk about the downside to these. These products are there's usually pretty long surrender periods, so you're tied up in these products for a long period of time. You could be 10 years, 15 years, or longer. Now we've seen some shorter year products come out. Just recently we've seen like 5 years. So there's just different ways to do that, and there's a lot of product out there. But you just have to be careful. And the other thing with an index annuities, you're not going to get the entire upside. Okay, so there's ways that they cap the upside, whether it's a participation rate where you get only a percentage of it, or there's a cap where they say, oh, you're only going to make a certain percentage, and then it stops, or maybe there's a spread, or there's all kinds of fancy ways the insurance company limits your upside if the market, because there's no downside. Okay. And then, of course, there's variable annuities, and variable annuities are, you can get a market-like return inside of a variable annuity. So there's stock and bond investment choices that really, they call them sub accounts, and they really act like mutual funds inside of a variable annuity. And they're popular because you can get tax deferral if it's not an IRA. That's important. You can put riders on there that guarantee the income, or you can guarantee the death benefits. So there's really a lot there with the variable product. We could spend a show on probably all three of those categories, Steve.
Now, and with annuities, that's the only time we can use the word guaranteed with our clients. So we do use products that are not guaranteed but have some safety nets. Mm-hmm. And recently there's investments, and I'll just say that they're trending investments, or they look for trends in the market and get in and out. What can you tell us about those?
Yeah, so there's a lot of different techniques that you can use to invest in the market. So we have trending or formulaic investing, or whatever you want to call it. What they're doing is they're using data to determine whether we should be in the market or whether we should be out of the market. So it's not a foolproof way to do it. I mean, there's still downside risk. It can still lose money when the market goes down, but there are ways to safeguard it to a degree where you can get out of certain investments if the market dictates that you shouldn't be in there.
And then there's really no cap to some of these.
There's no cap, so there's no limit to the upside because there's no protection on the downside. I guess that's the way to look at it. You can lose money with the investment, but the flip side of that is that if you have a good year in the market, you're gonna make whatever that underlying investment makes.
And then we go to something that's been around for a long time, which are mutual funds, and some of these are designed for dividends.
Yeah, so mutual funds, the mutual funds really cover a wide variety of investments. So, you can have a mutual fund that's tied to an index, right? So, and those tend to be low cost because there's not a lot of trading involved. So you just own whatever the index owns. So if it's the Dow, you own the Dow. If it's the S&P 500, you own the S&P 500. If it's the bond index, you own the bonds. So it really is designed to simulate the market. You can buy mutual funds, like you said, that are paying dividends, and then you use that as part of your yield, part of your your income strategy. Of course, the issue that you have to be aware of when it comes to those types of mutual funds is that there's risk to principal. So if the market goes down, you're gonna lose money. So and there's bond mutual funds that a lot of people build income portfolios with bond mutual funds, and that's a decent way to go. But again, you're subject to market risks. So especially in the interest rate environment that we are in, with interest rates being relatively low as we climb out of these low interest rates, that is going to could have some downward effect on the price of those mutual funds, because the bond prices are going to go down once interest rates go up. And we've been in a prolonged period of low interest rates, and really a prolonged period of a bull run, if you will, in the bond market. So these are all things that you and I have to keep our eyes on, right, Steve? Because this is what this is kind of what makes the financial world go round. These things have sort of a life of their own.
Yep, and mutual funds are a little, in the general terms, a little bit safer than, say, dividend-paying stocks. So, blue chip stocks and things like that for dividends. What does that look like?
Well, I think with mutual funds, the big thing that you're getting is diversification. So when you can get pretty good diversification with a small amount of money, right? So you can you can open up a mutual fund with just a couple $100, right? And then you're buying shares of the mutual fund, and you're getting instant diversification. So you own whatever the mutual fund. Let's say you buy into a great big mutual fund company's fund. Okay, so you might own a portion of maybe a couple thousand stocks. So then if one stock fails or one company fails, it's really not going to adversely affect you. I will say this: what you're getting when you're in with a mutual fund is you're really betting on the strength of not only the fund company but the fund manager. So the person who's or oftentimes it's like a team of managers that are buying and selling all these holdings that sit inside this mutual fund. So it can be tricky because these mutual funds are trying to outperform the market, trying to outperform their benchmark index. It's hard to do because there's a lot of buying and selling, a lot of trading costs, what have you. But that's really what you're doing with a mutual fund. You're trying to get that diversification. You're trying to get the yield, trying to manage the risk. It's all that, and often it's easy to accomplish that with just a couple mutual funds.
And when interest rates were higher, people could use CDs for income.
Yeah. So back in the good old days, I remember back in the early '80s, you could buy a CD that had a double-digit return on a CD. However, that's very deceiving because things are all relative, right? So even though you were getting double digits on your CD, there was also double-digit inflation.
Yes.
So in real terms, you really weren't that far ahead with the high interest rates. So now today, the interest rates on CDs are very low, but inflation's very low too at the same time. So things are relative. The other thing that you have to consider in today's market and today's environment is that we have this flat yield curve, or it's even at times an inverted yield curve. Mm-hmm. And what that means to our viewers is that if you can picture a graph, a timeline, the yield on a short-term note, like a 2-year bond or a 2-year note, is not that different than what you're getting for 10 years.
Yep.
Or 30 years. Okay, so that's what we call a flat yield curve. So let's say, we just said the 10-year note was 1.7.
Yep.
Well, the 2-year note might be the same.
Yep.
Or if it's higher, then we have what's called an inverted yield curve. So that's the world economy is not without its problems, right? So we're dealing with a lot of things that could be problematic when it comes to future the way future rates are going to be, the way inflation's going to be, and even the stock market. Who knows what the stock market's going to be like? We haven't even touched on that very much today, but the stock market has been heated up too. I don't want to say it's overvalued, but when we look at certain price to earnings ratios, it's high relative to what it's been historically. So, with all that being said, Steve, we take the show on the road. We're going to be doing seminars out in the public in the next couple weeks. So you can always look at our website, informedfamily.com, or you can call our office. And we always offer complimentary tickets to anybody who watches our show if they want to come out and see us live. We do the Social Security workshops. But anyway, time flies when you're having fun. It seems like we're at the end of another show here today. So with that being said, this is Financially Speaking.